Are oil speculators driving the price of gas out of reach? There's a lot of noise lately from Congress and trade associations for gas stations and convenience stores that a new villain has come to town. Responsible for $4 gas prices, perhaps even responsible for the collapse of the global economy, and despite the reality that the world's oil supply cannot meet demand, there must be something more nefarious than simple market economics. The new villain everyone can hate? The evil speculator. At recent congressional hearings, politicians and energy experts argued that speculators have artificially added $30 or more to the cost of a barrel of oil, turned oil trading into a global poker game, and doubled the price of gasoline practically overnight. But who are these party crashers? Where did they come from? And how are they doing this? And who can stop them? We'd all like to see a superhero swoop in and smite the speculators, saving Gotham from the peril of $4 gas. The only problem is speculators aren't quite the boogeymen that politicians want us to think, and they even play an important role in the oil markets and the global economy. Let's talk about some major misconceptions. Speculators are inherently bad for the economy. There's no doubt that speculators are out to make money by buying a commodity like oil, or gold, or real estate when they think the price is likely to rise and they'll be able to sell for a profit. But they also help sustain the market for buyers and sellers and provide ways for individuals and businesses to offset risk. Many companies, for instance, want to lock in the price they're going to pay down the road for petroleum products and other supplies they need to run their businesses. So they make arrangements with suppliers on a price they'll pay next year or the year after when they actually take possession of the oil. Buying and selling such futures contracts makes these companies speculators by definition, since they're placing a bet on the future price of oil. Companies doing this kind of hedging include gasoline refiners, airlines, shipping companies, and others that spend a lot on fuel or petroleum. Often they use investment banks or other intermediaries to arrange the deals. They might be gambling, but this kind of speculation actually helps companies run their businesses more smoothly. And if they guess right on future prices, it may give them a competitive advantage against other companies that didn't plan as prudently. There's a speculator star chamber somewhere. Global markets are so abstruse to ordinary folks that it's easy to imagine a cabal of evil geniuses pulling the levers from some fortified complex in London or Geneva. But that's the Hollywood version. The market is so competitive that that's nonsense. There's no way for everyone to communicate and get together and say, we're going to buy and drive the price of oil up. There are thousands of investors around the world placing bets every day on whether oil prices will go up or down, and they have no way of knowing who their fellow speculators are. All they know is the current price, shown on a computer monitor, plus whatever their own research tells them. Speculators are creating a huge bubble in oil. We've seen a bubble pop in the housing market, with home values now plummeting, and before that the tech bubble inflated, then burst. But the run-up in oil prices is probably different. The housing boom was generated by cheap, and in some cases fraudulent mortgages, not by a huge increase in the number of people who needed housing. The tech boom was similar to old-fashioned manias, where investors raced in hoping to cash in on a gold rush and bid the price of technology shares way above their inherent value. But in the oil markets there is in fact growing demand because of strong Asian economies. And supply is fairly fixed for now, since adding more oil to the market means finding new sources and spending billions to extract it, not just opening a spigot a little wider. Some oil experts argue that the supply is actually declining, since technical measures on the ease of oil flow lead them to believe we've reached the tipping point of oil supply globally. There are pretty strong fundamentals behind this run-up, says Sarah Emerson, another analyst at Energy Security Analysis. Speculators may be pushing oil prices somewhat higher than they would be otherwise, but a bust similar to housing or tech stocks seems unlikely. Speculators should be banned! Few, if any, economists or energy analysts advocate this, though the increasingly political nature of the discussion is making this harder to determine. Some fairly modest regulatory changes could bring greater transparency to oil markets and force them to operate more like stock and bond markets. Buying a contract for oil futures, for instance, typically requires the buyer to put down less than 10% of the value of the contract. The rest can be borrowed. That allows buyers to roll up big stakes with relatively little cash. Raising the margin requirement to 50%, the usual threshold for stocks, would cool demand for oil futures while still keeping speculators in business, and maybe get the witch hunters off their case. Tell truth to power. Hear the real story. Think for yourself. Join the conversation at econmilitia.com. Take back your inalienable rights.